Even the most illustrious investors and speculators have failed and lost money. The important thing is that everyone involved learned from their mistakes and changed their strategies. Here are 10 features of losses that can either help you reduce them or help you with advice on what to do if you experience them. But before continuing, please like this video and subscribe to the channel for future updates. With that out of the way, here are 10 ways to avoid losses in your investment portfolio. Let's get started. Stop loss orders. Let your earnings run, but keep your losses to a minimum. However cliched, this is the classic grand strategy, and it has stood the test of time. Because of technological advancements, it is now possible to restrict your losses in today's industry. Given how chaotic and volatile the world has become, a stop-loss order should always be available in your investing and speculating arsenal. It is essential to identify when to put a stop-loss order, how long it should be in effect, and how far away from the stocks or exchange-traded funds market price is to place the stop-loss order. Number 9. Employ trailing stops. The trailing stop is a stop-loss order that trails the stock price like a tail as the stock price zigzags upward. The moment the stock reverses and falls, the trailing stop-loss order stays put at the most current level. When and if the store does hit that stop-loss price level, the trailing stop turns into a market order and the stock will be sold. At that point, you've avoided further losses. Number 8. Go against the grain. When everyone and their uncle are exuberant about stocks, and the bulls to bears ratio is similar to the percentage of Red Sox fans to Yankees fans at Fenway Park, it's time to be a contrarian. A careful contrarian, that is. Starting to disengage from a party that is past its expiration date is an excellent method to avoid financial damage. You might miss out on a little more upside, but there is no harm in selling at a profit or employing other loss-limiting methods. Number 7. Have a hedging strategy. A hedging strategy in place after a crash is analogous to locking the barn door after the horses have fled. Preparing for a significant market turn is the best time to think about hedging your investments. A hedging strategy is simply knowing and doing what needs to be done to keep money safe or to lessen the risk of a financial situation. A hedging approach varies based on how long the predicted decrease is expected to last. In the event of a correction, you can consider hedging by purchasing put options. For example, when the market is in a downturn, you should look to sell and get some cash. Number 6. Hold cash reserves. Opportunities present daily and hazards arise to derail or postpone even the most well-laid plans. Still, the prepared investor always has cash on hand. Having extra money on hand is like having a secret weapon. It can also come in handy when your positions are down and you need cash to cover an unexpected bill. Number 5. Sell and switch. Can you do an innovative two-step while your stock is down to save money on taxes and set yourself up for a good rebound? Keep track of your unrealized gains and losses to see if there are any tax advantages based on what's going on in your portfolio. Perhaps you have the opportunity to book a capital loss by selling a losing position in your portfolio. Most of the time, capital losses that have been realized are tax deductible. You should check with your tax advisor to make sure. You can play the bounce in various ways, but make sure the tax loss makes sense in your situation and that you've done your homework on the stock or sector's prospects for a return. Consult your tax expert about your specific tax position. Number 4. Diversify with alternatives. Take into consideration the fact that, even if you have limited resources, you live in an era where there are many investing ideas and options available to you. While you're thinking about which stock to buy, you should list or research the possibilities that could help you make your investment decision better and help you avoid or even reverse any possible losses. The use of leveraged exchange-traded funds is an excellent illustration of this strategy. A leveraged exchange-traded fund is a speculative instrument that aims to replicate the underlying asset's movement by doubling or even tripling its value. Leveraged exchange-traded funds are a kind of speculation. They may multiply gains when you are correct, but they can also magnify losses when you are incorrect. Number 3. Consider the zero-cost collar. You own successful stock, but you're concerned. Although the store has some upside potential, the downside risk appears to be increasing. You don't want to sell the stock because the profit is significant and taxable. But you're concerned about the short term. Is it possible to protect your investment from a potential correction without selling it? Consider a zero-cost collar, which involves writing a covered call and buying a put on the same stock simultaneously, or an ETF. When you write a covered call, you get paid from the premium you get when you write or sell it, and you can use that money to buy a put. The stock price is boxed in, or collared, by this combination known as a collar. Here's how things could go down. If the stock falls in value, the put you purchased comes into play. The value of the put will rise as the stock declines. If the stock rises, you make a small profit when you sell the shares at the strike price of the call option that you purchased. But that's it. You can't make any gains above the strike price because the covered call limits your upside. The call you issued and the put you bought would expire if the stock remained flat or sideways. But don't be concerned. Your store is fine, and because both positions were purchased as no-cost collars, there will be no negative consequences when they expire. You didn't pay for the collar, so there's no actual loss. Number 2. Try selling puts. Assume you have a stock that is losing money. You examine the shattered pieces and notice that while the stock price is down, in the negative, everything else about the underlying stock and its firm is positive. Imagine you have a stock that has plummeted from $50 to $25 and is now wallowing in misery. Do you sell and take the loss, even if the firm is in great shape? Is the stock price down because investors have stopped investing in the sector because of short-term problems that aren't important to its long-term value? Assume the company is alright, but you might deduct the loss from your taxes. Capital losses in your portfolio are generally deductible. So instead of selling the stock, consider writing a put option on it. Why? You claim the loss on your taxes when you sell the losing stock. Also, because the stock has dropped significantly, the puts on it are likely to be fat, meaning they have gained a lot of value due to the firm's price decline. As a result, write a put option on that stock. You'll make a lot of money and you'll be able to lock in a decent deal because the put will force you to buy the stock at a lower price, the strike price in the put option. The main line is that you turned an adverse event, the stock market decline, into a positive one. And number 1, prepare your exit strategy. Stocks are supposed to be used as a means to an end. Supplies are purchased for various reasons, including income, growth, and sometimes both. Suppose you own an outstanding stock that pays out great and growing dividends. In that case, an exit strategy is either not a factor or not a serious concern. You devise an exit strategy for that type of holding if you require the funds for a reason unrelated to the investment, such as paying for your grandchild's college education or purchasing your retirement house with cash and no mortgage. When are you going to get out of your stock X position? And why is that? What kinds of scenarios might cause you to sell that stock? Consider your exit strategy before the need to sell arises. Many investors consider their exit strategy before making their initial investment. And that's it for today. What did you guys think of this video? Go ahead and let us know in the comments section below. If you enjoyed this video and you would like to hear from us again, don't forget to hit that like button and subscribe to our channel before you go. As always, thanks for watching.